A month from today, the Bank of Canada is expected to cut interest rates again. It will be the fourth cut of the year. But is it happening fast enough? Last week, we learned Canada's inflation rate is back to 2%. That's precisely at the bank's target, and it's a long way from 2022 when inflation hit a four-decade high. But interest rates are still above 4%. They're 17 times higher than they used to be before the bank started hiking to get inflation under control. James Thorne is Chief Market Strategist at Wellington-Altus Private Wealth. James Thorne, welcome to Power and Politics.
Thanks for having me, David.
You've been raising some alarms about the state of the Canadian economy. Well, what's happening in Canada right now that you think it makes it dangerous to have a key interest rate above 4%?
I think we as Canadians have to understand that our economy isn't the Americans or the United States, and we became very comfortable with the fact that we skirted by the global financial crisis. And now the chickens are coming home to roost, and we need to go through a significant restructuring period. And we need to get interest rates down to a level to allow the private sector to grow. I would argue since the Trudeau government came in, the public sector has been crowding out the private sector, and that can only last for so long.
So when you talk about a restructuring, you're talking about a restructuring of the federal public sector across all levels of government, or are you talking about private sector needs to restructure the way it's operating?
Yeah, the private sector, I lived in the States for 20 years and came back home. And what I can say to you when I came back home is the economy is too reliant on real estate up here. And I don't think that's a surprise to anybody. And what we do have is what we don't have now is a vibrant technology sector. We don't have a vibrant manufacturing sector. And, we need to be honest with ourselves that we need to put in place a plan to help Canada restructure for the digital economy that's moving forward. And to do that, we need to get interest rates down significantly to provide air to get into the private sector.
So how do you do that, James Thorne, when interest rates went up as a way of dealing with inflation that was over 8% at one point, and that is really the only instrument the central bank has available to it. But now it's caused some challenges on housing costs and mortgage affordability, and all of these things having a knock-on in the economy. So how do you get interest rates all the way down to allow for this competitive restructuring you're talking about without juicing the inflationary challenges they've been dealing with?
Well, David, I'm a classically trained economist, so what I'm going to do is I'm going to push back a little bit and to suggest to you that interest rate hikes are inflationary. And when you have an economy that is highly dependent on credit and needs a supply side structural adjustment, high interest rates are inflationary and stop the adjustment that's needed. Mortgage interest costs are a major contributor to CPI. So I would suggest you cutting interest rates. I know this sounds counterintuitive, but cutting interest rates would bring inflation down and would allow the economy to adjust, and that's what's needed.
Yeah, Armin Yalnizyan, who we have on this show, has advanced a similar theory that essentially the interest rates are hurting people on things they need, like shelter, and it can't deal with things like the price of food, which is sort of interest rate immune. It's a bunch of other things. But you think now it's just, making the cost of borrowing too high, squeezing too much money out of the economy because of the rent and shelter increases, that's capital that then can't be used for investment, productivity growth, these sorts of things?
Sure. I mean, if we simplify it down, when you have a high cost of capital, the economy doesn't work, right? And so we need to get the cost of capital down. But the risk that we have, David, is the fact that nothing has been fixed, in the sense that we're going back to a period of time between 2010 and 2019, where what the economists use is that the monetary policy transition mechanism. Mm-hmm. Canada cuts rates to 2% if credit creation doesn't increase. And credit creation is the purview of the banks. And if the banks aren't willing to lend more, then, it's great. Everybody talks about the fact that interest rates go down, but it doesn't really stimulate economic growth. Let me give you another nuanced fact. The way banks now are required, because of accounting standards, their loan loss provisions, they have to do this earlier in the cycle. In the old days, before 2018, it was later in the credit cycle. Now they're doing it right now. So I don't understand why people think that interest rate cuts are going to be such a magic bullet. And for me, and when we talk about to our clients at Wellington, is the fact that we think there's going to be a psychological aha moment middle to late next year when people understand that we're going to go back to this era that economists call pushing on a string or the liquidity trap, which is what we were in before COVID. David, nothing's been fixed.
Right, because a lot of people look at the really low interest rates in that period after the global financial crisis as making money so easily accessible. That maybe juiced the housing problem that we have in the country, right? And that it drove up prices by making mortgages so affordable. I mean, don't we risk going back into that if the bank cuts as fast and as deep as you're suggesting?
There's always going to be a counter, yes, but I would suggest to you there was a lot of confluence of events that came after the global financial crisis, and one was because our banks didn't blow up. I think global money realized that Canada was a safe haven, and if I was a very wealthy global family and I wanted to have $10 million in a safe haven, I would want to have it in Canada. Now, maybe that manifested itself in the real estate market. I understand that. That's fair. But I'd suggest to you that, I do not sit there and think that the economy is going to, the housing market is going to take off. David, I think this is going to be more like the 1990s when John Crow did the exact same thing as Tiff Macklin did, and the real estate market in Southern Ontario crashed, and the real estate market just traded sideways for a decade. And I think that's what's going to happen. I don't think we're going to go the era of massive price increases in real estate in Canada. I think is over. We know we've got a lot of supply coming on in Ontario, and so what I would suggest is they need to get interest rates down to about 2.5%, and then let's see what happens. That's sort of the neutral rate. But what I would suggest to you is that I think it's got to go lower than that, because I really do think that the Canadian economy, the private sector, is in a world of hurt, and it has been in a world of hurt for a long period of time. And I don't see how high interest rates is the magic bullet to allow the Canadian economy to do the major structural adjustments it needs to do to position ourselves for this new digital economy.
I spoke with, just as a final point, sir, Trevor Toome, who's an economist from the University of Calgary, I believe, a couple of weeks ago, talking about Canada's productivity gap relative to the United States on a GDP per capita basis. And not just the U.S., because they're kind of the global outlier, being the pace car of the world economy, but relative to the OECD. Do you see this prescription you're offering of getting the rates ultra low to allow this restructuring as a way of sort of closing this productivity gap that a lot of people are concerned about?
Yes, it's a direct consequence of what we're talking about. It's a direct consequence of the public sector growth in jobs and immigration. Yes, we need to have productivity growth. And I think Canadians really have to understand that if we don't do it, then our per capita GDP is going to be below the OECD average. This is a serious problem that we need to sit there and start thinking. Surprised that the Canadians do not understand how lucky they were in 2008 that they missed the pain that the rest of the Western world did. We are not going to be so lucky this time, and we need to have an honest conversations with ourselves.
James Thorne, thank you for having an honest conversation with me. That's James Thorne, Chief Market Strategist with Wellington-Altus Private Wealth. Thank you, sir. It's good to have you on the show.
Thanks for having me, David.